Hello, everybody. Happy Thursday to every single one of you tortoises. Welcome to the Like a Tortoise channel. Once again, hopefully you are all having an amazing week. And boy, do you guys like PayPal. Every time I put a video out on PayPal, the number of views just goes up substantially relative to the other videos, which is to say something. PayPal is a hated company. However, I know that many retail investors like myself are still very bullish on the company over time. Some of you have already made a few comments right here, so I will take I will take today to review those comments and to reply as soon as I can. But everybody, today's video is going to be on Evolution AB. I want to tell you about the recent 42% rally from the recent lows that the company has enjoyed, and whether I think this is sustainable, what I think from a fundamental standpoint, from a valuation standpoint, and most importantly, what I'm doing with our position in that company. Are we taking profits off the table? Notice that I mentioned profits. Yes, because unlike many people were buying Evolution at very high valuation levels, believing it could grow into perpetuity at significant growth rates, I was always more cautious, and I like to buy things when they are, let's just put it, when they are significantly hated. But I believe the fundamentals are still intact to some extent. However, what I'm saying is I like to buy quality when it's marked down. Just this summarizes my entire investment strategy. It doesn't have to be very high quality. I believe in buying quality when it's marked down, and do that for a few number of years, and you will see that you can double your money every 3 to 4 years, which is pretty much what I've been doing. Okay, guys, so Evolution AB, let's talk about what matters, and let's start by covering this company. For those of you who are new to Evolution AB, especially if you are new to the channel, I can give you some. I'm going to give you a context here. I'm going to give you a rundown of the company's backgrounds. I will discuss exactly what they do, what interests me about this company, what attracted me to this company in the first place, and we will take it from there. Okay, guys, so as you know, for those of you who are new to the channel, I have a school community right here, and in the school community, which is free to access, you can come here to the classrooms. Well, actually, it's free to access, but access to what I'm about to show you is meant to subscribers, to either premium or VIP members. So stock deep dives right here. This is within case studies, and you can see that Evolution AB, I always share a stock deep dives and also one pages on every single company that comes on the radar, and then I decide whether or not I should pull the trigger on that company. So you can see that Evolution is not an exception to that rule. Right here you have the stock deep dive, and right here, as I typically do, you can see all the questions that I ask before making any investments in a company. And these include, do I understand the business model? Do I think management capable? I gave in my opinion, I think it was a very complete, a very compelling, how can I say? I put out a video on Constellation Software, another one of our holdings, and you can see that video is almost 2 hours long, but I go through every single one of the questions that I ask whenever I'm interested in a given company. Okay, so these are all of the questions that you can see right here. This leads to a final question: should we invest in the company? So let's talk a bit more about the business model. By the way, the logo that we can see, that you see right here, is because we rebranded from All Human Invest to Like a Tortoise. So I hope this makes sense. Evolution AB is a Swedish company that develops, produces, markets, and licenses fully integrated B2B online casino solutions to gaming operators. First established in 2006, the company was one of the first providers of B2B live casino solutions in Europe, having since evolved from a rudimentary live casino roller game to a comprehensive ecosystem of live casino games tailored to various player preferences. What I really love about this company, guys, other than the margins and all of these things, is the fact that they literally have no competition in the online, in the live casino space. I mean, they own about 70% market share, which is unbelievable. The core of its offering includes traditional tables games, roulette, blackjack, and baccarat. Today, Evolution operates studios across Europe, North America, and offers the industry's most comprehensive product portfolio. They in any given year they release over 100 games, and those games are really cheered by the gamers because they are really state of the art games. I mean, no one else comes closer to producing the quality of games that these guys are putting out. And yeah, and that makes me feel that the growth runway for this company is still very, very attractive. Having been named Live Casino Supplier of the Year 10 times out of 10 at the EGR B2B Awards. Their customers include more than 600 operators, including most tier 1 online operators, platform providers, and several land-based casinos. Evolution Gaming develops partnerships with its customers in the established gambling markets to deliver world-leading live casino solutions designed to maximize every opportunity. Notable clients include DraftKings, Paddy Power, FanDuel, MGM Resorts, and Wynn Resorts. I don't know if any one of my dear viewers is familiar with some of these games. So, guys, if you have at any point in time played Evolution games, I'm interested in learning more about your experience. Did you like it? Are you do you typically play their games? Do you play any competitive games? And what's your take on it? So I'm very interested in hearing from you if you have gone through that experience. The company's business model revolves around offering innovative gaming content and platforms to casino operators, monetizing through licensing agreements and revenue sharing agreements. This is part of the reason why they have such a capital light business model, because of these licensing agreements. The more the casino operator, this is important, guys, they are not a casino operator. They are not a casino operator. They sell the software and the games to casino operators who then sell them to their customers. So Evolution does not have direct contact with the customer. They have a contact with the operators, right? So I think this is very important to understand here. And so they collect a fee whenever someone else is playing their games or using their software. Here's a breakdown of its revenue streams and how the company makes money. You can see that by far the live casino segment is the biggest contributor to total revenues. And this is where they have a big market share. No one comes close to matching them in this arena. And you can see that revenue is generated via revenue sharing agreements. Evolution earns a percentage of the operator's gaming revenue in fixed table fees. Operators pay for exclusive and customized tables. And so I hope that makes sense. You can see this is when I put out this report, this was about a year and a half ago, so it's not completely accurate. Right now, I think I think Asia, I'm not sure if, well, this is accurate in the sense that both Europe and Asia are still by far the biggest contributors to overall revenue. This is where they have the most exposure, even though revenues are growing fast across Latin America and North America. But still, as you guys know, if you have been following the channel for a while, sales have been sluggish in Europe and Asia, which are the most important markets. And this is why revenues overall have slowed down significantly if you compare the growth over the last 10, even 5 years. So I hope this makes sense as well. And so, yeah, this is it, everybody. And then another thing that I wanted to share with you is, let's talk about something that very cool that I was, as I was doing some preparation for this video, I stumbled upon a very good investment case on Evolution right here on Substack. And this is from who wrote this piece? What's the Substack name? Do I see? Yeah, the Wealth Dynasty report. They particularly, if you decide to come here, there is a section called the B2B Invisibility Framework, a proprietary analytical model. I think this is important, so I'm going to read this out loud to you as well. After analyzing 200 plus infrastructure businesses across cycles, I have developed the platform depth score to identify companies with evolution structural advantages. Platform depth score equals switching cost index times regulatory moat times content velocity divided by customer concentration risk. And this is important, guys, because in the case of Evolution AB, I think the vast majority of the revenues come from only 5 customers. So if I show you that right here, let me show you where I saw that. I think that is one of the risks that I highlighted. So let me go back. What are the main risks for the company? Dependence on key, here we go, fantastic. Dependence on key customers. A significant portion of revenue comes from a few large casino operators. Losing a major client could materially impact revenue. An important thing to highlight is that this was in 2022. This dependency has decreased ever since, which is good. However, they are still concentrated across the 5 top customers. So you can see back in 2022, the top 5 customers generated 30% of Evolution Gaming's revenue. That is something to bear in mind. However, because of the switching costs, and this already feeds into the company's moat, so the company's competitive advantages, which I discuss at length right here. So does the company have a competitive advantage? One of them, in my opinion, is you have economies of scale, but you also have switching costs. First mover advantage, proprietary technology and infrastructure. Look, innovative platform, Evolution, state-of-the-art live streaming technology ensures high-quality, seamless gaming experiences across devices, which is difficult for competitors to replicate. Scalable studio network. The company operates live studios in multiple jurisdictions, enabling efficient operations and localized content offerings for global markets. And then you have reliability, superior infrastructure and minimal downtime enhance player trust and retention. Here we go. This creates switching costs, creating a competitive moat. And then, of course, you have the product innovation, and they always release fantastic games as well. Not to mention the strong relationships that they foster with casino operators over the last 20 plus years. Everybody, okay. Economies of scale is also important, so hope that makes sense. But let's come back to what we were discussing. Evolution scores a whopping 94 out of 100 on this framework. Higher than Visa, higher than Unity, higher than most SaaS darlings. Here's why. Switching costs 9.5 out of 10. When a casino operator integrates Evolution's live casino, they are not installing software. They are restructuring their entire gaming floor economics. Integration touches payment systems, compliance protocols, customer data pipelines, and marketing infrastructure. My proprietary research indicates the true cost of switching exceeds 15 to 25 million for mid-sized operations, representing 18-24 months of Evolution's contract value. This creates negative churn. Clients expand rather than leave. Then you have regulatory arbitrage moat, 10 out of 10. Here is the inside conventional analysis misses. Regulated market expansion actually strengthens Evolution's monopoly. Why is he talking about that? He's talking about that because part of the bearish thesis against evolution is the fact that regulations, primarily in Europe, which, by the way, number one, have been self-inflicted, but they have, because they have caused revenues to slow down, they now believe that this works as a headwind rather than a tailwind. However, what he's saying right here is that regulated market expansion actually strengthens Evolution's monopoly as jurisdictions regulate online gaming. 30 plus in the past 5 years, three dynamics converge. Compliance costs eliminate 60-75% of potential competitors. Evolution's existing multi-jurisdiction licensing becomes a barrier worth 50 million plus to replicate. And remember, they have the first mover advantage. They essentially started this the online casino the online gaming casino experience about 20 years ago, and think about all the millions that the company has invested over the last 2 decades. Now, granted, that doesn't mean a competitor cannot come and try to compete with them, but they have so many years of investments ahead of the second player. It's mind-boggling. Newly regulated operators must choose established platforms to gain instant legitimacy. Content velocity 9 out of 10. Evolution operates 15 studios globally, producing 50 plus game variants. This is not technology, it's vertical integration of entertainment production. Because they control the studios, they control that software, so it's vertically integrated, so they control every aspect of their business. Each studio generates proprietary behavioral data from millions of game rounds daily, creating a self-reinforcing loop competitors cannot penetrate without equivalent sale. Evolution self-reinforcing monopoly architecture. And then if I you can expand this if you want, but you can see, let me just zoom in on this. Key insight, each layer compounds the others, creating a 94 out of 100 platform depth score. It's pretty cool, and needless to say that I agree with almost everything that he's discussing right here, certainly the most important aspects. So I hope that makes sense, everybody. And yeah, that is not to say that there's still that we don't have risks. As I already alluded to, some of the risks, for example, come in the form of, let me go and check this right here. Main risks for the company. We have some regulatory risks. Look, if you have a short to medium term orientation, then certainly Evolution has never been a company for you, because we don't know how long it will take for those for that to we don't know how long it will take for them to restart reacceleration. And yes, and they have always stressed that out during the conference calls. They believe that regulation can serve. They believe that they are very constructive on regulation into the future, but this can cause sluggish growth over the short to medium term. And I'm okay with that. I'm a long-term investor. I think the company is going to be in a far better position over the next 5 and 10 years. And so I remain invested. I have remained invested up until now because of that. Not to mention competition. This is always a risk with any company, frankly, even though they boost a significant market share. We already touched upon customer dependency risks, and then there are other ones right here as well. But okay, so look, this is what I wanted to discuss with you. So let's talk about now the fundamentals of the business and what I'm seeing from a like a tortoise lens. Right, so let me just take a sip right here. Okay, cool. So if we go here to the financials, you can see what the financials for the company look like. Starting with income statement, right here, you can see that revenues, which had been exploding from If you use, for example, 2017 all the way through 2023, you can see, in fact, let's do this like here, like this. Yeah, let's do it this way. Even, yeah, okay, cool. Is this? Yeah, okay. So you can see that revenue since 2017 have compounded by about 42.27%, which is incredible. Now, if we move on, if we zoom in on this and you check, for example, revenues of since 2023, you can see that revenue growth has been rather sluggish. And you can also see that since quarter four 2024, revenues have actually declined by about 3.78%. Okay, so this is one thing that you have to understand. Revenue growth has been explosive for the last decade. However, that growth has slowed down meaningfully. And so take that into account. Same goes for operating income. Look how profitability has contracted since December 31st, 2024, and it contracted by about 9.91% per year. And the same thing goes, of course, for net income, which has contracted even faster by about 12.1%. All of this against the backdrop of higher selling, general, and administrative expenses, because even though revenues have slowed down, in fact they declined, not just slowed down, they declined. You can see that selling, general, and administrative expenses, which is operating expenses, went up over the same time frame. And that is why you are seeing some margin pressure right here. Operating margins and net margins have been contracting ever since. Now, the key here, guys, do you think this is temporary or permanent? And why exactly is this happening? The way this is happening, the reason this is happening is because Evolution is a company that still has a lot of demand for their games, as they very often mention during the conference calls. And so they have to open new studios. They have to continue to invest in markets where the demand for their products goes up. And that includes Latin America, that includes North America, for example, in Europe, because the growth has been in a slowdown, they are not making as much investments as they were in the past, and this is a positive. Okay, so if I show you right here CapEx, you can see how CapEx, investments in plant, property, and equipment, has been pretty flat since December 34, 2024. Since December 31, 2024. So yeah, you can see that right here. And you can see that it's still going up. However, it's not like they are ramping up CapEx massively. That is not the case. And I like that because of the sluggish growth they are seeing in the most important markets. One thing important to say, everybody, in Asia, we saw two positive quarters of revenue growth. In this, you would have to go back several quarters to see that happen. So has the situation turned around in Asia? They had problems with cybersecurity issues and copycats. So remains to be seen whether this is in the rearview mirror, or if sales will decline again in the next quarter. This is something that I will keep you guys posted. But interesting to note here. In addition, if you look at free cash flows, obviously you can see that free cash flows have taken a hit as well. If we zoom in on this, you can see that free cash flows have only compounded by about, they have declined by about 4% since December 31st, 2024. So, of course, as I also already mentioned, this means margins are under pressure, as we already know. However, like I already mentioned, I do believe that this is temporary, not structural. In fact, a lot of the problems that we are seeing are cybersecurity issues in Asia. Doesn't necessarily have to do with Evolution AB's business model. Can that be a significant threat? Yes, but that is a macro aspect. It doesn't really have to do with with evolution itself. However, look, being Asia as such an important market for evolution, if I feel that the situation there is completely out of control, then I will let you know as well, and that will may very well change how I'm approaching this investment. Okay, guys. Now, looking at the diluted earnings per share, you can see that diluted earnings per share have declined. One of the reasons people had been so negative on the company was because, oh, they decided to cut the dividend. What are they going to do? Does the company want to go private? Are they many people believe this could be a move towards privatization. I always believe that as they mentioned, they found better. They don't think the dividends are the best way to reward shareholders. And sure enough, they cut the dividend and they announced that they will reallocate that capital towards buybacks. So diluted shares outstanding should increase. They should buy back as many shares as possible while the company remains at depressed valuation levels. I like to see that. In addition, everybody, I also want to bring your attention to this fact. Um, let's go. What's going on here? Can I see this? Okay, let's go here to financials. I want to show you financials right here. And then, yeah, if we go right here, no, statistics, you can see that they have stock analysis says that they have total debt of almost 1 billion, as you can see. However, they have about 12 billion in cash and cash equivalents. So the company is sitting comfortably in an 11 billion net cash position. And of course, that means they are in a very strong financial position. As you can see right here, they have practically no debt, which is outstanding. And they generate a ton of predictable cash flows exactly because of the nature of the company's business model. Take a look at this, guys. They can use a lot of that free cash flow to fuel growth, but also to buy back shares. And sure enough, you can see that even though margins have come down, that is important, you can see that they still boost margins that I have never seen before. I repeat, I have never seen a company boosting this type of margins. This is incredible. And sure enough, you can also see that the company allocates capital very efficiently. You can see that ROI sits at about 30.64 against a WACC of only 8.19. This means this means the economic spread is very, very appealing. And the company, and not only is the company not only is the company investing capital, right? So not only is the company making good use of its invested capital by converting it into profits, but they also have a very they also have many growth opportunities going forward, so they can continue to reinvest that capital at attractive rates of return. I like all of that. And sure enough, you can see that the shareholder yield currently sits at about 7.49%. They cut the dividend recently, so this is not accurate. They announced the dividend cut because they will use that to do buybacks. So you get paid while you wait, and you can see that the free cash flow yield sits at almost 9%. This is all incredible, guys. And if I show you this right here, my intrinsic value calculation full model template, you can see some of those. So this is already accurate. It reflects the latest trailing 12-month numbers, and you can see how attractive they are. So the company is very cheap. However, it boosts stellar margins, stellar returns on capital, and look how capital light the company is. CapEx relative to sales only 3.24%. CapEx to operational cash flow only 5.39%. Almost no debt. I mean, what else do you want me to say? This is just incredible. In addition, guys, you are talking about a company with very high skin in the game. If I show you this right here, if we go to the insider tab, you can see that insiders own approximately 27.52% of the stock. I mean, what else do you want me to say? Darth Kenneth, in and of itself, which is a private investor, owns about 25% of the company. That's why people were talking about going private, because they believe that Darth Kenneth was making a move here. He wanted the company to shift from a publicly traded company to a privately held company, but that doesn't seem to that's not going to happen. Per my understanding. And you can see, this is interesting. We have to highlight that. I can see there are many reasons why insiders would sell. That said, I see a lot of selling from Jens von Baar. I think he's the chairman of the board. He also happens to be one of the founders. And I don't know why he's been selling quite a lot, but you can see that before that, there was a lot of buying, including from the current CEO right here. So yeah, that said, insider ownership remains very, very high. So we are talking about a company with very high skin in the game. And I like that because our interests are aligned. Okay, guys, so let's talk about valuation right now. We discussed some aspects of the business model. We discussed the fundamentals. Now let's talk about the intrinsic value of the company. I will use Phil Town's 3 valuation methods for this, and I will also show you the reverse DCF to see what the market is to show you what the market is currently pricing in as far as growth is concerned. As always, I do these 3 methods, but I cover each and every single one of them in more detail in other videos. For the sake of this video, I will jump straight into the numbers. That said, margin of safety price is best suited for companies that are growing very fast. I'm talking about 15% plus growth over the next 10 years. And that is not the case for Evolution. Look at their growth over this is incredible. Take a look at these growth numbers. Ridiculous. I don't think you're going to see that again. I want to be clear. Do I think the company can grow at 10% per year over the next 10 years? Absolutely. Look, analysts are projecting about 9% growth going forward. I think the company can deliver 10% growth going forward. And so the current earnings per share currently sits at $6.97. If you grow 6.97 at 10% over the next 10 years, you're going to get an estimated future earnings per share of 18.08. And then if we assign this a PE of 20, which is double the growth rate, you're going to get a future share price in 10 years of 397 per share. Now we have to discuss that back to the present value. So because we always want 15% on our money, simply divide this by 4 and you get the intrinsic value of about 99. The stock is currently at $75 a share. However, we never pay intrinsic value. To that, we're going to slash 50%. So we always want to buy with a 50% margin of safety. 99 divided by 2 gives you about 49. The stock is currently at 75, which means you don't have the margin of safety that you would want. However, remember, this is not adequate because you will be punishing the company unjustifiably. I think I pronounced that word correctly. Is it unjustifiably? Injustifiably? Sorry about that. But yeah, so I wouldn't pay attention to this one right here. I would pay attention to both the payback time and the 10 cap rate. And let's cover them right now. Payback time, as you always know, we want to get our investment out of the business in no longer than 80 years, because the average payback time for an S&P 500 company is about 16 years. So if we get our money back in 80 years, we have a margin of safety built in. We start with latest 12 months free cash flows. we grow that free cash flows at 10% per year over that 8-year period. Then we add up all the free cash flows and we divide that by the number of outstanding shares to get the free cash flow 8-year payback time price of $84 a share. What does that mean, ladies and gentlemen? It means that if we believe Evolution AB can grow its free cash flows at 10% per year over the next 8 years, and if we pay no more than $84.55 a share, then we would be able to recoup all of our investment from free cash flows if we bought the entire company at this price per share. However, notice where the company is. The current price is 75.92. So this means that this means that probably we can recoup our investment in, say, about 7 years. Let me do the math right here. So if I add up all the free cash flows from year 1 to year 7, what am I doing? Right here, I get about 14 billion. And then if we divide 14 billion by the number of outstanding shares that you see right here, boom, you get about 70.14. So yeah, this means that our payback time is anywhere between 7 and 8 years, probably 7.5, 7.3 years, which is, it goes to show you how big a margin of safety you actually have if the company can execute on these assumptions. And I think I'm being conservative. And of course, with earnings, you don't have very different results because and this is what we want, because this means there is little manipulation. Over time, free cash flows and net income should converge. But the company converts the vast majority of their, in fact, they convert most of their earnings into cash, which is very good. And this is a testament to a very high quality company. And that's why you see higher free cash flows relative to earnings. Important to note. Now, let's have a look at the 10 cap rate. The 10 cap rate, again, we want to have a significant margin of safety. This one is the best one, in my opinion, because it doesn't assume any growth rates. So it was adapted from real estate. And the way it works is you start with operating cash flows, you deduct maintenance capex from total capex, you add the tax provision. That gives you total owner earnings. And then if you divide total owner earnings by the number of outstanding shares, you get the owner earnings per share, which if you then multiply by 10, you get your 10 cap valuation price of 79.01. What does that mean? The stock is currently at about that level, right? 75, and this is 79. So what does that mean? It means that if we buy Evolution AB today, and if the company doesn't grow its own earnings anymore over the next 10 years, we will still be able to recoup our investment in 10 years because this gives us a pre-tax yield of about 10%. Okay, that's essentially what it means. So total earnings, this is what you have, and then the 10 cap valuation price is 79.01. Once again, you can see that right here. A 10% cap rate means the business generates a 10% pre-tax cash yield. In other words, you are earning 10% on your money and would recoup your entire investment in about 10 years, even if the business does not grow from here. Okay, so what does that mean? Remember, all of these have a 50% margin of safety built in, which means that the intrinsic value of the intrinsic value of Evolution AB sits anywhere between 84 multiplied by 2, that gives you 168, and 150. Sits anywhere between $150 and $168. And now let's do the reverse DCF to see what the market is currently pricing in. And you start with current stock price that you can see right here. You will have the shares outstanding. I always want 15% on my money. So we will be discounting those cash flows at 15%. Okay. And then the free cash flow in year 1 is about this that you can see. And if we do this, if we assume 10% growth going forward, you can see that the intrinsic value per share is about $90 a share. What does that mean? It means that the market is not currently pricing in 10% free cash flow growth over the next 10 years. So let's lower that to 8% until it matches the intrinsic value per share here. And 7, bingo, here we go. 74.24, which is just about what the company is trading at today. This means that the market is pricing the company as though its free cash flows can only grow at about 7% per year over the next 10 years. Now, the question, ladies and gentlemen, is whether you think that is conservative, negative, or optimistic. My view is that the company can absolutely deliver at least 7% per year. And I think they can do 10% per year. But even if they do 7% per year, that should be enough to get us a 15% on our money per year over the next 10 years. Okay, everybody. Sorry, again, it was extended. Well, actually, I don't apologize. It was meant to be a deep dive, so hopefully you guys found a lot of value in it. And going back right here to Evolution AB, just before we wrap up the video, you can see how much the stock has rallied. Bear with me as I'm just waiting for this to reload. But going back here, you can see how much the stock has rallied from its recent lows of about 520. This is in SEC, take that into account. So the stock has rallied about 42%, give or take, from the recent lows. And this is, of course, makes us already in the money. I don't believe, once again, that the company is at near intrinsic value, because I think the intrinsic value of the company is, so if the stock is currently at 74, I told you, I do believe the intrinsic value sits anywhere between 150 and 168. And that is the range at which I would consider selling any shares in the company. Of course, especially if the price got there without any improvement in fundamentals. Okay, everybody. Make sure you smash the like button if you like this video, because that would certainly help the channel. In addition, for those of you who are new listeners, welcome to the channel. To give you more important information on how things work around here. Every single month, at the end of every month, we hold a live call for all of our subscribers and non-subscribers. It's a live call that you can join at your discretion. Make sure, if you want, that you book that in your calendar, because this month's live call will happen on the 27th of June. And I'm flying to Portugal on the 26th, so I'll be hosting this live group call on the 27th. Looking forward to that. This is where you can ask me any important questions that you may want, and yeah, about stocks, life, whatever you want. In addition, if you want to see applications for the month of June are already open, of course. The spots are running out, guys. There's only so many people that I can work with on a one-to-one basis to provide the best possible levels of personalization. So if you guys want to understand whether you are fit, whether you can qualify for the program, just jump on a call with me. Just click the link in the description, and that will lead you straight to a call with me. So guys, be safe. Thank you so much. I'll speak to you tomorrow.